Welcome back to another installment of Playing the Plan. Today we are joined by Grayson, lead manager of the U.S. equity strategy here at Mawer. First things first, welcome back to the podcast, Grayson.
Hey, Andrew, great to be back.
The last time you joined us was just a few months ago in April of this year, but a lot has happened since April. What have you been up to since the last time we spoke?
Well, we're working away. The markets have been volatile. A lot has changed over the last, year to date. That creates a lot of opportunities for us. The good news is that, when markets are flat or slowly moving up, there's much fewer opportunities. And so when markets are a little more volatile, it creates more opportunities. So that's been good. But otherwise, just, playing the plan.
Excellent. Yeah. So we're going to dive into the details of the portfolio shortly. But one of the topics that we've discussed a lot this year on the podcast with you and other guests has been the impact of inflation and rising rates. Those have somewhat a clear impact to valuations in particular. Another topic that has been coming up in client meetings is what about currency? And we've seen the US dollar rise substantially so far this year, really going back to last summer against a basket of global currencies. What impact does a big currency swing like that have on both the top line performance of a portfolio like yours and at the company level?
So a couple of things, a few reasons why currency is something that we spend a bit of time on, especially in times like these. Currency is driven by rates. So you see different rates in different economies because really you can invest your money anywhere in the world for a lot of people. And so if you get a 5% return on a government bond in one country and 3% in another, you're probably going to move your money from country B to country A and invest at a higher interest rate, all else equal. So the rates matter. Inflation also matters to this. Higher inflation usually leads to a weaker currency because you have decreasing purchasing power. A couple other factors that we think about too. A strong economy typically is a good thing in many ways, including for currency. And the other unique fact that the US dollar has is that it's a reserve currency. So you tend to see investors flock to safety in times of, in recessions or times of uncertainty. And so that's a big help for US equities because you'll see the US dollar be kind of propped up a little bit as people move their money from, perhaps riskier markets to the US market during a recession or preferably before the recession so that they can protect some of that capital. So what do we do? Maybe a couple more tangible examples of how we're thinking about this. One is the revenue cost mismatch. So, some companies have, revenues in one currency. Maybe they're getting paid in US dollars, but their costs, for example, their labor costs might be in another currency because their workers are in a different country. We don't have significant exposure to that. That's something we're pretty mindful of, and so we've tried to avoid that. The other one I'll mention is translation. And so that impacts our companies more because a lot of the companies we invest in are big multinational companies. So they have operations all over the world. And so while they have big US operations, they might also have businesses in Europe, for example. And so maybe they sold a product for $100 last year, like $100 US dollar equivalent in euros last year. But given the weakness in the Great British Pound or the euro, those sales are going to be could be worth 20% less this year than last year. And so that's just kind of less money that's being moved over from that geography to the US at the end of the year. One thing we've done to address that is just tweak our portfolio a little bit in terms of shifting a little bit to more domestic companies. It's not the only reason we bought some of these, but it's a consideration. So companies like utilities that are all 100% US based, or a company like Marietta, which is an aggregate company, is US based, or Paychex, which is another company that's primarily US based. So those can help reduce some of those currency risks.
Excellent. Yeah. So obviously the US dollar is still cementing its status as a safe haven currency, and some great examples of how currency affects the businesses that you're investing in. Coming back to the topic of inflation, generally speaking, we're all aware of how this is showing up for consumers. think we have a pretty good idea as to how it shows up at the company level, generally speaking. But with persistent consumer inflation, it's typically only a matter of time before those consumers will require higher wages, higher salaries to afford those higher prices. Are you seeing meaningful wage pressures in the businesses that you own? And what are the potential impacts or ways in which companies can manage through that?
Wage inflation has been around 5% recently, so quite high, certainly in more recent times. And that's combined with unemployment being low, unemployment at about 3.5%, which is like a 50-year low. So those work together. Why is this important? Well, if you're getting if you're getting paid 5% more than last year, you're probably going to keep spending, or perhaps even spend more money than you did, which increases demand for products. The companies that you work for are probably going to try and offset the increased labor costs by increasing the price of the products they sell. They don't want their margins, they don't want the amount of money they make to fall. So they're going to try and offset that by raising the price of the product they sell. And it's just it's a kind of vicious cycle. As they raise their prices, then workers demand more money the following year to pay their bills. It can be a really tricky thing to defeat. One of the things that is a little bit different is that wage inflation seems to be more impacting some of the lower paying jobs a little bit more now. For a while, it's been had a pretty big impact on some higher paying jobs, which are some of the companies that we deal with a little bit more. So if you think about a company like Google or Visa or Texas Instruments, they're trying to find some of the best programmers in the world. They're trying to find some of the best engineers in the world. And so those have been in short supply in recent times. And so they've had to pay higher wages each year and seen wage inflation for several years now. So I think some of those companies are a little bit more used to wage inflation. Where you're seeing it more now in companies that are perhaps a little bit less used to it is in the kind of lower wage jobs. So you saw Amazon raise wages for their warehouse workers not too long ago to $15, and they've since raised them again. We tend to have less exposure to companies with a lot of kind of lower wage workers, and so we feel like the portfolio is a little bit more protected. We went through an exercise recently and company by company and looked at that and felt like our portfolio was in good shape there. So that's positive. One small example of how you can benefit from wage inflation, what some of these companies are doing, are we have a company in our portfolio called S&P Global. So they are primarily a ratings business. So if you think about getting a bond rating, so if you issue debt and you need a rating for that debt so that buyers know how risky that debt is, you go to S&P Global. They bought a company about 4 years ago now called Kensho, and that was a artificial intelligence, AI analytics business. And what they've been doing since they bought it is using that technology to try and automate more of the processes at the company. And so that's how they're offsetting some of that wage inflation pressure, is that they are finding processes within the company that they can automate using just analytics or artificial intelligence, and kind of replacing people with machines, basically in some of those roles. And so that's been quite effective for them. And we've seen similar things in a number of the companies we're looking at. So there are ways for these companies to offset that.
Some great examples of just how the macroeconomic situation is finding its way down to the company level here in your portfolio. I wanted to shift gears a little bit into some of the micro level topics that we've talked about before. And the last time that you were on, you talked about the utility sector, and you just mentioned it again. In particular, at that time, you explained a deeper dive that you did on the industry. Can you just briefly remind us of what you did there and why you did it, and ultimately whatever came of it? Did you make some investments or some divestments out of that?
We had known utilities for at least 15 years prior to looking at them in 2020, 21. And that was a good decision. They didn't perform that well, underperformed the benchmark over that period. But we thought we'd revisit it again. What we found that was a little bit different than over the prior decade was that utilities now have a runway to deploy that capital. So, and they can deploy it at a 9 to 10% ROE. So that's pretty positive. A lot of companies can deploy some capital, but often they can only deploy a certain amount of capital before they're going to run out of good ideas. And once you just run out of good ideas, the returns tend to fall off. But with utilities, they seem to have probably a 15-year plus runway of good ideas where they can invest and get a 10% return on equity. And that's because they need to spend money to improve the electrical grid and to invest in renewables. So yeah, we did a big deep dive on the industry, spoke to 9 companies, many sell-side analysts, did a bunch of reading on the industry. And as a result of that, we added 2 companies to the portfolio, the Southern Company and AEP, American Electric Power. And based on that kind of core thesis that they can deploy capital into improving and making their grid more resilient, and they can invest in renewables such as wind and solar.
And are you seeing them deploy that capital as you as alluded to, and are you seeing some benefits of that in the portfolio already?
We are, yes, absolutely. They have a long-term plan, which is another attractive feature of utilities. As you know, Andrew, we're long-term thinkers. We're investing, trying to invest over a 5 to 10 year time frame, and utilities are very similar in that they have a 5-year plan on where they're going to invest capital, and they've followed that plan, and it's worked quite well over the past year or so. They've been a bit of a safe haven in these rocky markets, and they've been able to deploy that capital into projects that are helping out, that are making the grid more resilient in the face of things like hurricanes and wildfires that you see more of these days, and they're able to diversify the sources of energy from used to be coal was a big part of it, or natural gas, and now shifting over to still having some of those, but also having wind and solar, which is also quite positive given the macroeconomic environment where you're seeing things like the Russia-Ukraine conflict, where it seems like sources of energy can be cut off to certain parts of the world. So it is quite valuable to have wind and solar as an alternative.
I want to pick up on some of those investments into renewables. That strikes me as a theme that is likely more prevalent than just within the utility sector or the energy sector for that matter. Are there other businesses that you own where there's a tailwind to their long-term growth potential because of that theme that you just touched on?
A couple come to mind. One is Amphenol and another is Linde. Amphenol is a company that makes interconnects. So if you think about electrical wiring between different parts of devices, they are basically the wiring and the connection between those different devices. So you could think about your vehicle. Maybe 10 or 15 years ago, you might have had windows that manually rolled up or down, or you might have moved a mechanical switch over to turn the heat kind of up or down. Whereas now it's probably on most newer cars, it's just a touch screen, and you touch the screen. And so all that happens, obviously it still happens because you have to open and close vents or move windows up and down. So there are, the mechanical movements are still happening, but it's just happening with more interconnects behind the scenes. So this is a company with a great management team, a great business, and we think some pretty attractive skew. And one of the reasons is because of exposure to electric vehicles or EVs. And so not only do they make these interconnects that I just mentioned between, say the infotainment center in the middle of your, between the passenger and driver's seat, but they also make the interconnects between, the battery and the motor on your vehicle. And so a lot of these interconnects are quite inexpensive. They may be 1% to 2% of the product costs. Average cost of them, I believe, is 66 cents. And so, very cheap for, a company like Ford or GM making a car for $50,000. They're not too worried about, 50 cents or $1 for an interconnect. But they certainly don't want to have any issues with those. They don't want to have a recall because they, tried to save 2 cents on some wiring going to to a kind of untrusted source. And the other big factor is with Amphenol, you're seeing 2 to 4 times the content in electric vehicles that you did in ICE vehicles, internal combustion engine vehicles, and that's even higher in kind of higher end EVs like the Tesla Model X. It's about 4 times the content. And so they really benefit from some of these shifts to kind of greener alternatives, and that seems to be the way the world's going these days. And so they're a big beneficiary from that. And so we like the fact that you get that upside from a company like Amphenol while still getting, some of the core things that we like to see, like a strong management team and a reasonable valuation. The other one was that I mentioned was Linde. So this is very similar actually to Amphenol. They've got a great management team. We've known them for years and owned the company for years. So one of the things that that's interesting about this investment is they both benefit from higher oil prices. They're an industrial gas company, and so you use different gases like oxygen in different industrial processes. You might want pure oxygen to in a combustion process, for example. So they're both used in energy like oil and gas right now to help with refining in chemical production. So they're benefiting from some of the higher oil prices right now, which is good in terms of helping the resiliency of the portfolio. As you know, we're not trying to bet on the economy moving one way or the other. We're trying to make the portfolio more resilient in different scenarios. And so they benefit from that, but they also have benefit from the shift to hydrogen. And so you're just starting to see this now a bit more. But we think this is going to make a fairly big impact for companies like this over the next 5+ years. Hydrogen is a high energy density fuel with zero emissions. The problem in the past is that to make it, you basically had to burn fossil fuels. So that kind of offsets the benefit of it. Now you're starting to see, with more solar and wind being built, you're starting to see excess energy at certain times of the day. So maybe there's just a lot of sunlight across the country in the middle of the afternoon, and it's just more than you need to power businesses and homes. So what you can do with that is use that excess energy to make hydrogen, kind of clean hydrogen, because you're using green energy. So that's quite positive. It kind of ties into utilities, which we talked about. And Linde is going to be a big producer. They're a big producer in hydrogen today, but we think over the next 5+ years, they're going to be a much larger opportunity for them. And so we think that's a great investment opportunity over the next 5+ years.
Just sticking with some of those longer term themes that may impact businesses that you own or would like to own. Deglobalization has been talked and written about extensively. This was something that was unfolding to some degree the past few years. COVID obviously accelerated that with the supply chain issues that came about. And more recently, you've touched on the geopolitical tensions that are out there that are flaring up, may accelerate this deglobalization theme even further. What kind of impact does that have on your decision-making within the portfolio?
We've seen a big shift. I mean, there's, I think in the, several decades before, prior to this, it was a globalization theme where, you're shifting, you saw a lot of manufacturing being shifted from countries like first world countries like, the US to more developing countries, like China and other countries in Asia. And those countries have kind of benefited and developed as a result of that. But yeah, as you mentioned, Andrew, now we're starting to see a bit of a reversal of that. Partly it's countries like Russia in the war with Ukraine. Russia is not a huge part of the global economy, but they're certainly part of it. And so that's the sanctions have impacted them. China is also, you've seen kind of tensions flare up with China, both because of I think it was highlighted by the pandemic, really. I think a lot of companies didn't realize how dependent they were on China or on single factories in different parts of the world, and when they couldn't get products out of that factories, that was a big problem for them. And so I think a lot of companies are seriously thinking about diversifying their supply chain now and moving some production closer to the end markets. One example of this that I think could illustrate the point is semiconductors. So semiconductors are, the brains and the memory of computers. A lot of them were made in low cost parts of the world. A huge amount are made in Asia. And so we've recently seen the passing of a bill called the CHIPS Act in the US, where the government has really realized that these semiconductors are critical to the functioning of the economy. A lot of the stuff that we use today, from automobiles, smartphones, computers, rely on these chips. And if you can't get them, you're in a lot of trouble. And so the government in the US is really trying to incent these manufacturers to bring production back to the US and to kind of take it away from China. And so one company we own that's involved in this is Texas Instruments. This company is a great management team, and that's really one of the reasons we've owned them for several years. And so they're really ahead of this theme. One of the things I'll actually highlight while talking about this that I think is just important is that I did the initial work on Texas Instruments several years ago, but the most recent update, a colleague named Ian did the update on this. He was looking at several semiconductor companies globally, and he works on the EFI large cap team, and so he was looking at companies in Japan, other regions of the world, and said, "Hey, you know what? I'm doing this update on semiconductor companies. Do you mind if I take a look at Texas Instruments too? I can do the work for you and perhaps give you a bit of a global perspective that you might not have had otherwise." And so I think that's just a bit of a sidebar to highlight the fact that we have one process, one team at Mawer, and so it's quite an advantage that we can think globally on things like this. And so as part of that update, we talked to the company, and they have a number of fabs which make the chips in the U.S. have been shifting even more of their fabs to the U.S. over the past several years. They have 8 of their 12 are in the U.S. now, and they're building 5 new kind of high throughput fabs over the next few years. And so, this is a great way to benefit from having domestic production, not having to rely on China, and not having to worry so much about supply chain issues or shipping or just geopolitical tension, interfering with their ability to get supply. And so, this has been great. And the other thing that I'll highlight too is, once again, this is something that is quite beneficial for long-term investors like ourselves. And a lot of other investors are kind of, I guess, upset with the fact that they felt like maybe Texas Instruments shouldn't be spending this money right now. These plants take a few years to be brought online, and so you're spending money now, and you're not getting the returns for a few years. But for investors like ourselves, this is perfect. Because these are high return projects, and yes, you're not getting the money now, but if you're thinking over 5, 10, 15 years, the return on capital for these projects is quite high. And so this once again aligns perfectly with the way we think about things, and makes the portfolio more resilient by kind of taking out some of the supply chain and geopolitical risk.
Yeah, that general theme of deglobalization strikes me as a massive shift happening in the world. And you and I grew up in an age where it really was marked by the proliferation of manufacturing and trade around the world. And I think this is going to be something that a lot of our listeners and our clients are certainly paying attention to as we move forward, because it could contribute to some of the longer term inflationary pressures that we've been talking about. You mentioned Martin Marietta earlier. Is that another name that might fall into the camp of this general theme?
It is. And this is a nice combination of micro and macro. Martin Marietta makes aggregates, so gravel. So nothing too special there. They mine it out of a quarry. And what is interesting about this commodity versus others is that commodities like oil and gas are global, so they're very expensive. They're easy to ship. A lot of the production comes from different regions of the world, and to a certain extent, as we're seeing in Europe right now, you can be fairly reliant on countries like Russia at times when you don't want to be. Aggregates is the opposite of that. It's a very kind of hyper local commodity, because gravel has a low weight to value ratio, so meaning that it's quite cheap. You're not going to pay a whole lot of money for rock. So that means you can't ship it very far because it's very heavy. And so to take a truckload of rock from a quarry to your to your house to make a new garage pad or to pour a new foundation or something like that to lay it under a new road, you don't want to be trucking it across the country. And in fact, it's typically about 50 miles is the distance that you can ship it before it becomes too expensive. And so that attracted us because it leads to less competition. These quarries are tough to build generally because people don't tend to want a big quarry right beside their neighborhood. It creates dust. There's huge trucks driving in and out all the time, and so they're hard to get permits for. And so as a result, there's not too many of them in big cities. And so you're really only competing with maybe 1, 2, 3 other quarries when you're selling these products. And so the competition is much more restrained. And so as a result, you get a bit of the benefit of a commodity, which is in this environment, one of the benefits is they tend to be able to increase prices with inflation. So as you're seeing, like we talked about before, inflation being a little bit higher than it has been in the past, these producers are able to increase prices of their products with inflation so they don't see their margins fall. But they don't have to worry about the huge swings in commodity prices or other regions of the world bringing on more production that's going to really crush the prices of their product. And so, that's why we added this to the portfolio fairly recently. Is we really like that it added some resilience to the portfolio. It's a strong competitive advantage business, trading at a reasonable price, and in a good economy, it does quite well. But it also is able to add resilience to the portfolio in times of inflation when a lot of companies get hurt.
Yeah, maybe just before we let you go, I want to pick up on that theme of resilience in the portfolio. Given the rapid rise in interest rates that we've had so far this year, another theme that has emerged is the risk of a slowdown or even a recession in parts of the world. And we've already had a significant re-rating of stock and bond prices so far in 2022. So here's a two-part question for you to wrap things up on. One is there more pain to come, given the economic damage that we might be seeing unfolding over the next year? And what, if anything, can you do about it in the portfolio?
Yeah, on the first part, is there more pain to come? There certainly could be. It does seem like inflation staying quite high. You're seeing wage prices, wages continue to increase. You're seeing, more companies looking to increase wages, which is probably going to lead to more pressure there. Unemployment seems to be staying low, and rates are going up. And a lot of companies haven't seen their earnings really correct a whole lot yet. So it doesn't seem like they've kind of felt the brunt of some of these cost increases yet. So there certainly could be more pain to come. But as you know, we don't tend to try and spend too much of our time thinking about these kind of things. We prefer to build resilient portfolios and invest in companies that are going to do well if the economy does better than expected over the next year or two, or if the economy does worse than expected over the next year or two. So a few examples of these that we think are going to lead to good outcomes, regardless of how the economy does, are companies like AmerisourceBergen. So they are a distributor of medications. This is one where very few people stop taking medications in a recession, for example. A lot of medications dramatically improve your quality of life, and so that's probably going to be one of the last things you're going to stop doing if you lose your job or you have less money to go around. And so as a result, they're going to keep moving prescriptions from point A to point B, from the manufacturer's facilities to their warehouses to the pharmacies where you pick them up. So we view that as being a fairly resilient business. Another example would be a company like Hershey. So of course, many of you are going to be familiar with Hershey. They make chocolate. Tends to be a relatively cheap indulgence. You don't really need to eat chocolate, but when you only have to spend $1 or $2, even if the economy's tough, you might view that as, you might cut back some of your, spending on other indulgences that are more expensive, and maybe just focus on something like this. And you saw that in 2008-9 time period when we went through a big recession in North America. They grew throughout that period, and so they're mostly exposed to the United States, kind of over 90% of their sales, and so you don't have a lot of currency risk with them as well. Kind of going back to one of the points we talked about earlier. Another couple examples would be Intuit. Intuit has two businesses. They make tax software, TurboTax, and they also have a small business accounting software. And unfortunately, you cannot stop paying taxes if you're making less money or if the economy is tough. So they keep collecting money, and your small business is going to likely to continue to run. There'll be some businesses that don't make it through, but that tends to be a fairly small amount, and a lot of businesses keep running, and so those tend to be fairly resilient. One last one would be Verisk. So it's a company we've owned for a while. They collect data from insurance companies, and this is data that's required by regulators. So the regulators want to capture a lot of insurance information on aggregate rates of car accidents, for example. So companies can use that to price their car insurance. The insurance cycle tends to be independent from the economic cycle, and so we view that as a way to create resiliency in the portfolio. If we're worried about the economy and a recession, the insurance cycle operates at a different kind of wavelength to the economic cycle, and so the two, the insurance cycle, for example, is doing quite well right now, while the economy is doing quite poorly. And so that's a way to create some resiliency in the portfolio, because those companies tend to be making a little bit more money now when others are making less because of the weakness in the economy. So that's one of the reasons we like that. It creates a more resilient portfolio. So those are a handful of examples of companies where we think they're going to do well in a variety of different scenarios.
All right. Well, three things I know I can't avoid: taxes, insurance, and ultimately chocolate. That's a great place to wrap up. I always enjoy our conversations, Grayson. So thank you very much for making time for us today. And I look forward to the next time we get to chat.
Thanks, Andrew. Had a lot of fun as always. Thanks for the chat.
All right. Take care.